Greetings, everybody. We are tackling accrual accounting, adjusting entries this week, and for some extra help, I decided to put together a brief video on the assignment for this week. Again, I'm not going to do the assignment. I'm not going to give the answers out, but I'm going to kind of walk through it to try and help with it. So with this assignment, it starts with giving you an unadjusted trial balance for a company. Okay, so these are all their accounts, and these are the balances all these accounts have, debits and credit balances. The first thing you should do when you're tackling this assignment is take it account by account and update the ledger for each account you come by. So for example, the unadjusted trial balance tells you cash has a debit balance of $34,000. Right away, put in $34,000. Before you do any journal entry, you want to copy over what you have here into the ledger. This way, once you do your journal entries, you can update them and the accounts will be correct to what they should be. Okay? So again, just go through teaching supplies, put in what it says here before you do journal entries. Now, let's look at the journal entries. So I'm going to kind of talk through each one again briefly. Not going to give you the answer. I'm going to talk through it and kind of give tips. So 1A says, an analysis of the insurance policies show that $2,400 of coverage has expired by year end. Okay. I know these are a little sloppy. There we go. All right. So $2,400 of coverage has expired. If we look here, prepaid insurance has a $12,000 balance. So let me open up something quick. Let's say I'm going to make a similar problem. At some point, a company prepays their insurance for the year, totaling $10,000. Okay? So whenever you prepay an expense, insurance is an expense. You debit an asset account, prepaid whatever you're paying for. In this case, it's insurance. You debit it for $10,000, and you're going to credit cash for $10,000. So this is what the company has already done. This is not what I'm telling you to do for the first one. This is what's already done. So now the company has a trial balance that says we have prepaid insurance at $10,000. Now, if I say at the end of the year, $4,000 of the insurance has expired, that means that $4,000 of the insurance has been used up. That means you can now officially recognize $4,000 of insurance expense. So what you would do is you would debit insurance expense, I didn't need to do that, of $4,000, and you would reduce the asset prepaid insurance. I spelled it wrong. I'm just trying to move a little quickly here, 4,000. So this is similar to what Part A is asking you for. Okay, this part's already done. This is what the company must have done in the past. Your job is then to say, hey, how much has expired? I'm going to recognize that portion as an expense and credit prepaid insurance. All right, so let's keep looking. If we look at Part B, inventory count shows that teaching supplies costing $2,800 are available at the end of the year. So again, with adjusting entries, guys, at the end of the year, you update certain accounts. So throughout the year, if you use a pencil that costs $1, you're not going to recognize teaching supply expense for $1. You're going to wait till the end of the year and total everything up. So if at the end of the year, inventory count shows teaching supplies costing $2,800 are available, but we have $8,000 worth of teaching supplies on the books, that means the difference is an expense. So let me go over here. Say we have teaching, let's just say normal supplies. Again, I don't want to make this too much like the problem. Say we have supplies on our books totaling $20,000. At the end of the year, we add up our supplies and only have $2,000 left. So if we had $20,000, but now we look, we only have $2,000 left, that means $18,000 was used up. This difference of $18,000 gets moved out of supplies and into expense. So we would debit supplies expense $18,000. We would credit supplies $18,000. So again, supplies are an asset account. It's almost like a prepaid account, honestly. It just doesn't say prepaid. So you recognize supplies as an asset when you buy them. Then as you use them up, you recognize an expense. So use this logic to answer part B. All right, let me look down. Part C, depreciation. C and D is depreciation. I'll do one example to cover them both. Depreciation is a decline in value of a fixed asset. A fixed asset is property, plant, or equipment. Some long-lived asset, like a computer, a building, a desk, I just had a brain blank, a big super television that you use for your business, something that's long-lasting. So when you have depreciation, let's say a company has depreciation of $20,000 on one of their buildings. No matter what, depreciation is always going to look like the following. You're going to debit depreciation expense for $20,000, and you're going to credit an account called accumulated depreciation, and you're going to specify what the asset is. So building, $20,000. Accumulated depreciation is a contra asset account. Okay? It's a contra asset account. It reduces the value of its associated asset. So on the balance sheet, when we're in the asset section, we would have buildings. Say the total value of buildings was $100,000. Then below it, we would have accumulated depreciation buildings. And it would be a negative $20,000. So then the net amount, the net worth of the building is $80,000. So it cost $100,000, it lost $20,000 in value, it's now $80,000. So this is how you do the journal entry for any type of depreciation. Just make sure you specify if it's for equipment, building, etc. And then this is how you would set it up on the balance sheet. So pay attention to this too, because you have to do the balance sheet for part of this assignment. Okay? And then depreciation expense itself up here is an expense that goes on the income statement. So just make sure you toss that in there in the income statement. Okay? All right, what else we got here? Depreciation. All right. 41. On November 1st, Katie agreed to do a special 6-month course starting immediately per student. The contract calls for a monthly fee of $2,500, and the student paid the first 5 months' fees in advance. When the cash was received, the unearned training fees account was credited. The fee for the 6 month will be recorded when it's collected next year. So unearned training fees is unearned revenue. It's just a specific unearned revenue account. Okay? Unearned revenue is a liability until real revenue is recognized. Okay? Real revenue is recognized when it is earned. So when you actually perform the work to earn the revenue. So a situation similar to the problem, let's say on October 1st, a company receives $20,000 from a customer. They agree to send the customer goods on December 31st. So on October 1st, the journal entry would have looked like this: a debit to cash for $20,000 and a credit to unearned revenue. Again, you could be more specific. You could say unearned merchandise revenue, unearned goods revenue, anything. So this is a liability saying that in the future, we have to provide a service or provide goods for this unearned revenue of $20,000. We already received the cash. In the problem that we're dealing with, they've already made their journal entry. On November 1st, they already made a journal entry. What they're looking for is now on December 31st, what do you do? So on December 31st, with my make-believe problem, we are providing them the goods. So we're going to send them the goods. So now that we sent them the goods, we are earning the revenue. So we have to debit and get rid of our liability. Debit unearned revenue, 20,000. And we're going to credit sales revenue or any type of revenue, however you want to put it. Notice we don't debit cash again. We already received cash in the past. Now all we are doing is we're recognizing that we've earned the revenue. Okay? Up here, when we first made the contract on October 1st, we didn't provide the customer with anything but our word. So we didn't do anything to earn the revenue. That's why we recognize unearned revenue. December 31st, we provided the revenue, so we get rid of the liability by debiting it. We credit sales revenue. Okay? So in this problem, keep this in mind. On November 1st, they recognize 5 months worth of fees to cover the next 5 months. Each month is $2,500. This, what we're doing here, is for December 31st. Okay? So on December 31st, we need to recognize only 2 months of this revenue. Okay? They recognize it as unearned training fees. So when you recognize it as revenue, you're going to call it training fees. Okay? Training fees earned. But keep in mind, only 2 months you're recognizing. Okay? That's all I'm going to tell you. October 15th, Katie agreed to teach a 4-month class beginning immediately for a student for $3,000 tuition per month, payable at the end of the class. The class started on October 15th, but no payment has yet been received. Katie's accruals are applied to the nearest half month. So what this is saying is, as of December 31st, Katie has earned revenue because she's provided a service. She's provided 2.5 months worth of a service. December, November, and then half of October. She provided 2.5 months of a service to a student, but the student isn't going to pay until it's all over with. Okay? So what Katie would have to do is she's going to have to recognize a debit to accounts receivable. So remember, accounts receivable is a placeholder for cash. And she's going to do it for what 2.5 months is worth. And she's going to have to credit a revenue account, specifically tuition and fees earned is a revenue since it's a school, tuition and fees. So this is the opposite of the last one. The last one, she received cash but didn't do anything to earn it. In this one, she earned revenue, but she's not receiving the cash yet. So this is the general setup you're going to look for when you're doing that journal entry. Just keep in mind what the amount should be. G, WTI's 2 employees are paid weekly. As of the end of the year, 2 days of salaries have accrued at the rate of $100 per day for each employee. So let me say this. So companies don't always pay you as soon as you make your money. Normally companies pay you weekly or bi-weekly, maybe even monthly. So if I say this, on December 31st, a company owes an employee $500. It won't be paid until a week after the new year. So what GAAP, generally accepted accounting principle, says is that whenever you incur an expense, paying your employees is an expense, you have to recognize it, even if you don't pay it. So these employees worked for them and they've incurred $500 worth of an expense that they have to pay those employees. The year is over. They're going to make their financial statements, but they're not going to pay the employees for another week. So what they would do is they would recognize salaries or wages expense of $500, and they would credit a liability, salaries payable, recognizing that they have to pay their employees $500 in the future. So use this as a general guideline when doing G. And then H, the balance in the prepaid rent account represents rent for December. So what this means is, where are we? They recognize $3,000 of prepaid rent for December. It is now December 31st. So they have incurred that month of expense. So this full 3,000 was for the month of December. They prepaid it. Now December is over. So you have to recognize that as an expense. Think about what you did with prepaid insurance. Once you guys do all these journal entries, update these ledgers. Again, the ledger should have a starting balance. All of these accounts, put them in before you do the journal entries. So look, I'll do one more. Teaching supplies, put this in, $8,000. Then, when you adjust teaching supplies in your journal entries, you're going to come in and you're going to credit it. I'm not going to tell you where you're going to credit it for, but you're going to credit it. Okay, and you're going to do this for all of them. But first and foremost, put these values in the ledger. Then take your ending balance. Let's just say you have to credit teaching supplies $5,000. That's not the amount you're going to credit it for. I'm just saying. Your teaching supplies balance is $3,000. It's the ending balance. So when you make your adjusted balance and you type in teaching supplies, make sure you give it a $3,000 balance. Okay, and it's a debit balance. It had an $8,000 debit balance. You credited it 5,000. 8,000 is more than 5,000. So this 3,000 is a debit. And you're going to do this with all these. Take your time with it. Then from your adjusted trial balance, make your financial statement. List your revenues independently. Okay, we have tuition and fees earned. That's a revenue. And we have, what was the other one? Training fees. That's a revenue. So two revenues, list them independently. List all your expenses then independently as well. Revenues minus expenses, net income. Beginning equity, use the starting equity from the trial balance, add a net income or subtract a net loss, subtract any drawings if you have them, and then the balance sheet, make sure you put in your assets. Again, you see it's kind of shifted here. The reason this is shifted is because of the depreciation. So remember how I said on the balance sheet, this is kind of how depreciation, you show your asset, you show your accumulated depreciation, then a subtotal. This is why this little section looks like this. Okay, that's just a hint. All right, so fill everything out. That's all I'm going to give you. I think that's quite a lot. And see how you go. You could email me questions, but I'm not going to get more specific on giving the answers. I will tell you if you're right or wrong, though.